U.S. citizens and green card holders residing outside of the U.S., including the British Virgin Islands, are required to file annual income tax returns whether or not their revenue was obtained inside or outside the United States. Any person holding a U.S. passport is considered a U.S. citizen, and green card holders are always considered permanent U.S. residents, regardless of where they live. Sean Rose has the details.
FATCA is an important development in U.S. efforts to combat tax evasion by U.S. persons holding accounts and other financial assets offshore. Under FATCA, certain U.S. taxpayers holding financial assets outside the U.S. must report those assets to the IRS on Form 8938 or Statement of Specified Foreign Financial Assets. The FATCA requirement is in addition to the long-standing requirement to report foreign financial accounts on a form called Report of Foreign Bank and Financial Accounts, or FBAR. FATCA also requires certain foreign financial institutions to report directly to the IRS information about financial accounts held by U.S. taxpayers or by foreign entities in which U.S. taxpayers hold a substantial ownership interest. The reporting institutions will include not only banks but also other financial institutions, such as investment entities, brokers, and certain insurance companies. American citizens and residents are subject to U.S. taxation on their worldwide income, even when they don't reside in the U.S. KPMG's FATCA specialist Douglas Harrell, who was recently on an educational drive in the BVI, says FATCA is another mechanism to identify those citizens who have not been filing their income tax returns.
If you're filing all your tax returns and always have been, FATCA has zero impact on you. And it's really just another mechanism to, I guess, to encourage or compel or give the IRS more information to encourage you and compel you to, as U.S. citizens living anywhere in the world, to file your tax returns and pay U.S. tax if necessary.
It is important to note that the FATCA requirement is not specific to the BVI. Financial Secretary Neil Smith confirmed that FATCA was developed to reach U.S. citizens and green card holders who have not been filing their income tax returns, wherever they may reside in the world.
If U.S. citizens were reporting on their global income, there was 100% compliance. There'd be no need for FATCA. There'd be absolutely no need for it. So it's a mechanism to improve compliance with what you have as what is an obligation on you as a U.S. citizen or alien resident.
FATCA requires certain U.S. taxpayers who hold foreign financial assets with an aggregate value of more than the reporting threshold of at least $50,000 to report information about those assets on Form 8938, which must be attached to the taxpayer's annual income tax return. The reporting threshold is higher for certain individuals, including married taxpayers filing a joint annual income tax return and certain taxpayers living in a foreign country.
Your name could be on a bank account with your husband, your brother, and your sister, 4 or 5 different people. If you're the only U.S. person for the FBAR report, you still have to put that highest balance of which you're a partial owner of. But for income tax purposes, if you're on an account with your non-U.S. spouse and it's generating interest, let's say, and it generates $100 of interest, $50 of that interest would go on your tax return, $50 would not. So the point to take from this is the non-U.S. person marrying a U.S. person does not subject themselves to the U.S. tax rules.
All governments who sign an IGA with the U.S. will act as a mediator to facilitate the process of information sharing. Financial Secretary Neil Smith says the Virgin Islands government will have to amend the existing Mutual Legal Assistance Act.
The amendment to the existing legislation would facilitate the agreement between the BVI government and the U.S. government. Under that legislation, the competent authority, which is in the Ministry of Finance, I think right now is the International Tax Authority, can, if they find that someone is not doing what they're supposed to be doing, they have some enforcement powers, so to speak, to make them give the information.
Those who are required to file Form 8938 and do not do so may be subject to penalties. Failure to file carries a penalty of $10,000 and an additional penalty of up to $50,000 for continued failure to file after IRS notification. and a 40% penalty on an understatement of tax attributable to non-disclosed assets.
What can they do? Can they come and seize your property here?
Well, it's difficult to seize property in another jurisdiction of any foreign government. They're not as forgiving, the IRS isn't, if they get you first, if you know what I mean. But if you come forward first and put it out there and make your case, there is a chance for penalty relief.
Meanwhile, Harrell says U.S. citizens owning property outside that country will only be required to pay tax when income is being generated from any such property.
The ownership of real estate is not reportable to the U.S. government. Now, if that real estate is generating rental income after expenses, if you have net income, then that could create taxable income for you.
The provisions, commonly known as the Foreign Account Tax Compliance Act, or FATCA, became law in March 2010, and focuses on having U.S. taxpayers report about certain foreign financial accounts and offshore assets by foreign financial institutions about financial accounts held by U.S. taxpayers or foreign entities in which U.S. taxpayers hold a substantial ownership interest. Sean Rose, JTV News.